Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, August 27th, 2019. In this video, I'd like to go over some trend indicators that I use. These are a couple different trend indicators on various time frames, from the long term all the way down to shorter term trend indicators. In the last couple weeks, I've put out a video on various breadth indicators, what that's telling us, looking at market breadth, internals, and how to use those indicators. I also did a video more recently on using market sentiment, investor sentiment, various sentiment indicators, and again, what they're telling us now and how to use those. So we'll follow up here with some trend indicators. And let's start out here. Well, I'll show you what I'm looking at here. I call it my quad layout. I have 4 different trend indicators, and we'll zoom in on each one. It's probably hard to make out in the video, so I'll expand each chart. But this is my longest term indicator up here on the left, with using a monthly chart, and you can go back decades on that one. Here's a weekly chart, and when you go down the line here, this is a daily chart using just a simple pair here, the 50 and 200-day exponential moving average, and then another daily chart with a couple different trend indicators that are a little bit faster. And what I mean by faster, when you're looking at, in this case, obviously these are longer term because they're monthly and weekly charts. These are both daily charts. By faster, I mean the moving average periods are shorter, and so the lower you go, for example, this one you have a 50 and a 20-day, you're going to have, they're going to respond quicker to prices versus your longer term indicators. So these might look like they're lower numbers, but they're not, because this is a monthly chart. So therefore, there's 28, 29, 30, or 31 days in a month, depending on the month, and right here, so you have this occurring every day. So in other words, these are much slower longer term averages because they're based on the monthly candlesticks or the monthly closing prices in this case. All right, let's look at each one, and we'll go through that. We'll just look at the S&P 500 and the NASDAQ 100 in this video, and kind of get down to these short-term trend indicators. Start out here with the longest term trend indicator, the monthly chart. And you can see again, it has up top, you can see there's 3 things we're looking at up on the top of the chart. The black line is the S&P 500, so in all these charts that'll be the index we're looking at. And for this purpose, just use a line chart. No reason to clutter things up with a candlestick chart. And then you have a pair of 2 different moving averages here. In this case, they're both exponential moving averages. We'll use simple moving averages at times, but for these trend indicators, I like exponential moving averages. So we have a 10 and a 6, the blue line being a 10 EMA, and the red line being the 6-period EMA. And it's pretty simple, yet effective. When the pair makes crossovers, bullish or bearish crossovers, in other words, this is your faster EMA. Since it's a 6-period, it will move faster, respond quicker to price changes versus a slower moving average. So when the fast EMA crosses down below the slower EMA, like you had right here, that gives you your sell signal, or at least indication. That's our trend indicator that we went from a bullish trend to a bearish trend. As I go through these charts, keep in mind the longer term charts you use, and the slower the indicators, or if you're on the same, if you're on the same time period, like I said, maybe a daily chart, and you're using some faster and versus slower EMAs or trend indicators or whatever you're using, the slower trend indicators are going to take longer to trigger a signal. They're less prone to whipsaw signals. As we go through this chart, we're looking at decades of history here, and you'll see just a few small brief sell signals. And whereas the faster moving averages or the faster trend indicators on the smaller time frames, they're going to get you in and out quicker, but they're also going to provide more whipsaws. So that's the trade-off. And that's why I look at everything. And then most importantly, these, like everything else, are not standalone buy and sell signals. You could actually, if I go through the video, you'll see that in a lot of these cases, if you're just, hey, Randy, give me something simple. I don't have time to keep up with all these posts on the 60-minute charts and everything the Fed is doing this back and forth. I just want something to manage my 401k. Well, this is about as good as it gets right here. These especially the longer term, these monthly and weekly trend indicators. And I'll let you be the judge of that. So, all right, let's walk through it. Let's dive right into it. This period here was the longest bull market in history up until that point. This one just took the title. But back in the 90s, we had a very strong and persistent bull market. It ended with the dot-com bubble pop when that burst back in March of 2000. The S&P fell a lot less than the tech-heavy NASDAQ back then. But either way, you can see this up top, the first indicator down here is simply that 10-6 EMA pair. I've created a custom histogram. I've put together video in the past. If you remember the site and you want to know how to use that, how to create these, let me know. I'll just give you a link to the video. It's also on the YouTube channel should be under educational. There's various playlists on the YouTube channel for right side of the chart, which, by the way, just scroll to the bottom of the site. There's a little YouTube icon. You can click on that and it'll get you there. And again, if you can't find it, just let me know. So what the histogram does, it simply tells me, it gives me a quick visual of when the lines cross over. And you can also extract some other useful information, such things like divergences that work very well on by my momentum indicators and other things. But you can see, for example, here, and that would have given you a heads up even before you had the sell signal. But let's just look at that. So again, it told you throughout that, up until then, the biggest bull market in history right there, and it told you stay long. It is a primary bullish trend. This indicator kept you in that for the most part. I think if I zoom in very closely there, you'll see a little whipsaw signal. Nothing's perfect, and of course you would have had the shorter term trend indicators firing. There was a decent correction in there near bear market back there, but yeah, so you can see just taking a quick look at it, pretty darn accurate. And again, it's not going to get you out at the top or in at the bottom, but does a pretty good job of defining the larger trend. That's what we're watching now, and that's why I'm doing this video. I talk about shorter term sell signals, breakdowns, but you can see there, not a bad job to keep you long throughout the last bull market, the one back in the 90s, get you out, tell you to stay short or at least stay out of the market till then, and then same story, got you in the next bull market, kept you in throughout most of the bull market. This was the Great Recession right here, that dropped from late 2007 into March of 09, and then at this point right here, it looks like we went positive there. It said, okay, new bull market underway, or new primary trend. It's like I always say, there's not a single indicator out there that's flawless. You'll see a couple little whipsaw signals along the way, and again, take this into the big picture. It shouldn't be a standalone indicator. You should use it with the other trend indicators, use it with more importantly price, support levels, trend lines, everything that I focus on in most of the videos. But this again is painting the bigger picture. So that's where we're at, and you can see, oh, by the way, okay, so that's the EMA pair again shown up top in here in histogram form. Down below, I'll use the ROC12 on a monthly chart. That's the rate of change. Sometimes I'll change that depending on the security of the index. I might toggle around to ROC13. It tends to when you go to a higher number on the rate of change, it's going to help filter out whipsaw signals. And you can see, again, I'm scrolling back for many, many years. These were bear markets in themselves back here. It doesn't look like much, because when you go out to such a long time frame here, you'll see that these little blips that might not look like much were very much, bear markets. And there's Black Monday right there, the big drop, 20 something percent in one day. So that was a quick bear market. And of course we topped before that, and it caught most of that, if you can see very closely. But okay, that's it. So where we're at now, fast forward to today, we've had a couple whipsaw signals. Remember, this was a near bear back here in 2015, 2016, in quite a few sectors, even several indexes like small and mid caps, they did enter bear markets, dropped that threshold of more than 20%. So it's not as if it was a bad whipsaw. It told you, hey, heads up. And again, the other takeaway and the nice part about these histograms, look for the divergences. They're going to give you a heads up when the momentum is changing again between these lines, and that would have helped to maybe get you in a little early, especially if you had sell signals, which we did on the broad market back then, so you didn't have to wait till the whipsaw, till we got the red monthly bar. That's that, and here we are now. Still, like I said, my longest term trend indicators have remained bullish. We had a couple whipsaws back here in December. You can see those right there. But one of the things, the reason I have two different indicators here, one scrubs the other. So, for example, yeah, that was certainly a false sell signal. But right here, we had the 1060 MA pair still red for the month, but yet the ROC 13 was green again. So that, if you want to look at it that way, if you want to give the benefit of the doubt to the current trend, that negated that signal. Next month, you can see same story, or same story in reverse. We had the 10.6 cross back bullish, and again, it's a monthly chart, so all that really matters here is how you close the end of the month. Now, if you get a very big red histogram bar during the month, and you, let's say you have a week to go, chances are you're not going to, and nothing the market's going to do is going to get you back over there. So in that point, you can jump the gun on the signal. But if you just have a marginal crossover like this, you might want to hold off. And again, there's other long-term trend indicators that I'm not covering in this video that I have in the past, and those are other things you want to look at, such as, for example, that 20 period EMA on the monthly charts that I've showed you before. SPY, QQQ, they are above it and they've remained above it. So there we go. So that's it, and not much more to talk about other than we'll keep an eye on this one, and let's now zoom down to the other ones. Now that I've explained how they work, we can move through the rest a little quicker and see what they're telling us right now. So that was the monthly chart right there. We're going to go here to a weekly chart. We can even flip over to SPY. You can see they're going to look the same. SPY tracks the S&P 500 nearly perfectly. And this one we're using a 17 EMA and a 43 period EMA, again on a weekly time frame. So you can see the lines above, and the histogram just simply tells us when they cross. And as you can see, does a pretty good job right here. Let's just show you of getting you in and out. Again, we're going down a little short on the time frame, but you can see it's done a pretty good job. Not perfect, but pretty darn good of capturing the bulk of most of these trends. So again, the takeaway for this one would be 401k investors, for example, less active traders that might want to say, okay, I'll use something like this. It's going to keep me in these trends in the market. I'll catch the bulk of the trends. I'll get out. If you short, great, you can actually profit from these drops. If you don't short, at least you get out, and then you get back in. Like any trend indicators, the problem with trend indicators, the pros are when you have these pretty clear trends, they work great. Sometimes you get sharp corrections within the trend, and you get the whipsaw signals. And again, it's just part of any indicator. It's not going to be perfect all the time, but when you look at the track record, it does a good job. And the other point is that you want to stay away if we get into a prolonged sideways market. 2015, 2016 was a great example right here. We went sideways for almost 2 years from where we topped. From the point we topped to the point we finally moved away from that, it was about roughly 2 years. And so there, you're going to get whipped around with certain trend indicators. But there it is. So there's a pretty good track record. You can see going back to the 90s here with a little bit of whip. And that wasn't even a whipsaw. There was money to be made on the short side, and definitely about another, also close to 2 years, at least a year and a half of sideways to down trading. And you can barely see the histogram, but they did go red. And other than that, you can, like I said, almost a near perfect track record for capturing the bull and bear markets. So this one, again, my one word for this bull market, biggest in history, is supersized. It's like, going to McDonald's, ordering the supersized fries and Coke. You get this giant tub of Coke, this huge basket of fries. And so my point of that is, because of the scope and magnitude of this market, you get the corrections are really, almost bear markets, by the old metric, 20% drops, but they're very large, and therefore it's triggered some sell signals here, some whipsaw signals. Or you can look at it this way: if you put the crosshairs right here where this one triggered, got you out right there. Let's just say you got out of your 401k. Well, guess what? The timing wasn't perfect, but you avoided this. So it does a good job of saying, hey, something's wrong here with the market. And again, we'll watch this one. It's not yet triggered. Last time it gave us a sell signal. Here, we'll zoom in real tight. Was right here, and you can see that didn't work for you because we had the big drop. It triggered the sell signal, and that is why you don't use it by itself. Now, if you remember, if you were with the site or even following the YouTube channel, we were short here. And at this point, I started saying the risk reward is no longer favorable for shorting. We're going to have a snapback, rubber band stretch. It's going to probably be a big one. And then I was, clearly bullish throughout that. So this is just one reason where this didn't matter. I wasn't talking about this back then, saying, oh, we've got now a sell signal. Let's stay short. No, it's again, sometimes and I do put a higher weighting on price, using price levels, support, resistance, trend lines, divergences. Again, 95% of what I'm covering when I put out charts and videos on the home page and in the trading room. And so this one we'll watch right now. You might be getting a little bored at this point, saying, well, these aren't triggering. Why are you going over these? Again, something to watch longer term. And I'll tell you this too. The market, this can go, you can see as it did here, these indicators can go from solidly green to a sell signal in very short order. The market tends to fall a lot faster than it rises. So, we went down here where you could have these long-term indicators flip, possibly, well, probably not by the end of, well, certainly not the longest term by the end of this month, but maybe in the next month or so. Let's go down to the next shorter term, and this is where we'll kind of, this has more to do with what's going on right now. All right, so this is the SPY. We're now down to a daily chart and a very simple but old tried and true. I've been using this one since I can remember. This is just a great pair. The 20 and 50 EMA pair does a good job of defining bullish and bearish trends. Anytime you're using any EMA pair, they call it the nickname for a bearish cross is a death cross, and a bullish cross is called a golden cross. Meaning, when I say bullish cross, the faster line moves over the slower line. And again, it's all represented down here in histogram form, so you can see it's done a pretty darn good job, and it's a faster trend indicator. And right now, it's telling us the market is on, at least by this indicator, a sell signal. So what do you have here? You had a pretty much a whipsaw down in that last drop that we had right here. And let's just go up there and show you. Yeah, it triggered a little too late, so that was a whipsaw. And again, price would have, we may have been, I believe I think we had an official QQQ trade that we covered right before there and closed out at the final target, if I'm not mistaken. I think that was back then in June. Either way, we're on a sell signal now, and although there are some whipsaw signals, this one you got a sell signal, and it caught the bulk of that. It told you again from this point to this point that this trend indicator was on a sell signal. Did it again here, from right here to right there, and it got you out or kept you out of this mess, maybe helped confirm a short. And again, divergences and other things, sometimes I don't see them right here, but sometimes you get a little heads up. No, there's some divergences right there, and that was before the biggest correction. So you can see nice divergence there. By divergence, I mean we had a higher peak right here on the histogram and a lower peak, yet prices over that time were making higher highs. So that's your negative divergence there. This time around, no, not positive divergence. Let's scroll back a little bit and just take a look at that. Here's another period where it did a pretty good job of capturing the trend. If we go like this from here to here, actually your sell signal was right about here. Oh, we can see it with the lines. There it is. Get out, get in. Right here was your crossover. There was your sell signal right there. The only whipsaw was a slight, I mean, if I zoom in, a slight green, but probably not enough to shake you out. So it told you to get short there, or get out of your longs there, and get back in. So there it is. So pretty good job overall. And now we have one shorter term. And we'll just do this and we'll go through QQQ real quick and wrap this video up. So here's the some faster EMA pairs. In this case, I actually have 2 histograms down below, but only a single line above. So there's really 3 trend indicators on this chart. One, super simple. It doesn't get any more simple than this, and yet pretty darn effective. And that's just put a 20-period exponential moving average up on your daily chart. And there's 2 takeaways. I use it in 1 of 2 ways. Number one, when prices are above the 20-period EMA, the trend is bullish. So in other words, the black line, this is the SPY. When you're above, the trend's bullish. When you cross down, there's your sell signal, a bearish crossover, or I'm sorry, just a drop below that EMA. And it does a pretty good job. Like I said, it's a shorter term indicator. You're going to get whipped around a little bit more, but it told you there, hey, get short. These were just whipsaws, and I don't think there were any. In fact, we were, gaming actively, looking and identifying these bounces on the 60-minute charts, and then hitting bounce targets, and then getting back short again. And so again, this would have helped you there, maybe confirm the short entry that you had with a trend line break. I remember there was a trend line back here at that point in time. You can see it there in the markets. So that was your sell signal. This helped to confirm it, and you can see again did a pretty good job. Now, the other use of this, other than just the price of the index being above or below, is I like to look at the slope of the line. This goes back to high school math. You have a slope is when the line is going up. A positive slope is any time the line's headed up. A flat or zero slope or no slope is a flat line like this, and a negative slope is anytime the line's heading down. So right here, you went from all along here, even though the prices moved low, you had a little bit of a whipsaw there. It turned down a little bit, but other than that, the whole time it was going up. So you had a positive slope, and here the line turned down, and there's your trend. So you can see the 20-month is showing you the trend, and it's helped smoothing out all the zigs and zags in the market. These whipsaws that I know drive a lot of traders crazy, market up, especially during periods of a lot of volatility. So where are we at right now? Again, I told you there'd be takeaways, not just how to use these indicators, but where the market is now. Well, we're still solidly below that 20 right now, and you can see the trend was bullish here when we crossed over. We remained above it. It gave us a sell signal there, and we've been bouncing up against it and staying below it right now. So by that, both aspects of the 20 EMA sell signal, or current bearish trend. All right, so then down below, same thing as before. I have some histograms with a couple of EMA pairs, 3913 and a 2613. And you can see, same story. When those pairs cross, they trigger. These two are going to be very close. There's not a huge difference between the 26 and the 39 because I'm using the same 13 EMA. But you can see it's captured the bulk of the trends there, and just again helped to confirm the larger term trends. This has been the last few years. We've seen what appears to me to be a market in a topping process, a 2+ year topping process, or around 2 years so far. And so therefore, there's been some whippiness in here, and that's part of the nature of this. So once we get a clear trend, I think the next trend coming, next big trend will be to the downside. Those longer term trend indicators will flip, and then we'll probably have a little less whippiness here in these shorter term trend indicators. And as far as whippiness goes, let's say this was, in this case, the sell signal was solid. It was right there, came somewhere in here, and this was your whipsaw signal. The whipsaw was a buy, not a sell signal. So pretty much, because you could see for most of this period that we remained on a sell signal with these indicators there. And again, it did a really good job here without any whipsaws, telling you to get out, stay out, even on these 3 counter trend rallies. And so far, that's been the case here. So we'll see. Again, this one wasn't so hot as far as, well, it did not a bad job. Let's see. Yeah, it did an okay job of telling you when to get out. And And oh, by the way, and I use these more so, they help to really identify the early part of the trend, when to get in. Like I said, you don't want to wait, because when you have corrections, the one thing about corrections, the market falls hard, but then, especially when the trend remains bullish, the recovery rallies, the snapback rallies can be pretty powerful. So again, you'll use other technicals, divergences, moves, down to support, trend line breaks and all that to get you out early, so you don't otherwise, in that case, yeah, it got you out or short through most of it, but by the time if you held off till here, well, look, you're back to where you started. So that's why I say you use these in conjunction with price and trend line breaks and divergences and other chart patterns, things like that. And we'll just walk backwards in reverse. In other words, I'm on that short-term trend, so I just flipped over to QQQ, and I won't spend, since I've already explained how these work, I'll just confirm that we are still, by all these trend indicators, all four. Remember, at the top we have two. We're below the 20, and we're also the slope of the line is down. So that's the short-term daily trend indicator. Here's the intermediate term daily trend indicator with the 2050s. That's QQQ. And we'll just zoom in a little bit. You can see that it recently triggered. It put us on a sell signal. Actually triggered back here. And that's when the histograms cross. So we're going to say those little few green blips are actually just, or maybe right here. You can see they crossed right there. Yeah, so that's got us on a sell signal now. This one didn't really do a great job. This one did a really nice job of, again, getting you in short or out of your longs, and not such a bad job on telling you, hey, the trend's flipped back to bullish. So there it is. Same here. Let's go back a little farther, and you can see, look, there was that great run. They call it the Trump pump. Following the elections, and you can see just strong advance. With virtually very little, small little whipsaw signal right there, but other than that, did a pretty darn good job. And again, over time, did a good job right here, getting you out, not too far past the top, and then telling you here, letting you again either side skirt that bearish trend or profit from it on the short side. Same here, right about there. Told you to at least stay out of the market. Again, more of a whipsaw there, but the big trends. Here's the point, guys. By the way, remember, everything on these shorter term trend indicators. I already showed you the what I consider excellent track record on those long-term trend indicators capturing the bull markets and the bear markets, the weekly and monthly charts. Now we're looking at a daily chart, and you're going to say, well, I see quite a few whipsaws, mostly green. Yes, this was a bull market. So again, these trends are help you try to identify the corrections, and again, you can use a jump. You don't have to wait till the lines cross. In many cases, you can see divergences building before the trend indicator actually flips. So that was, in most cases, your heads up there. Hey, we've got divergence building on these on the custom histograms down below. There's big divergence. Look at that one. That's telling me that this is where the takeaway is as well on these divergences. Look at the clear negative divergence leading up to this. And again, this was the biggest correction throughout the bear market or bull market since March of 2009, and it was clearly foreshadowed here by divergences as well as boom, that indicator firing. But the divergences told you in advance that was most likely coming, as did many other things in the market, by the way. Price, trendline breaks, XLK breaking down, negative divergences there, etc. And then the weekly chart, weekly trend indicator on QQQ. Let's zoom out. Still bullish right now. So again, these are things I'll be watching in the coming days, weeks, or months to see if this one fires. Obviously, this one should fire before the monthly, the longest term. You can see where we're at right now. So the lines are there, but remember, this histogram is a visual representation of how far apart the lines are. So in other words, at this point, at the reading of 5.21, the lines were that far apart there. There you can see they fell in pretty short order and gave you that sell signal. So things could change quickly, but as of now, these longer term and intermediate term trend indicators are still bullish for the time being, but we'll watch those. And again, the point of these guys is to tell us with a pretty good degree of certainty when we are in the next bear market, because there was the last bear market and this thing caught most of it. Even there was a nice bear market rally to trade, very profitable. Either get out of your shorts, side skirt some losses on your shorts, or trade it on the long side. I like to do both. And that one told you that back then. You can see it, zoom in a little tighter there, you can see that. And other than that, if you're a long-term investor, I told you, hey, get out of the market there, actually right there, and don't get back into right here, and you then sidestepped almost all of the last bear market. So the whipsaws to me are worth it. Even if you wanted to just trade this in your 401k, if you look at this chart and said, all I'm going to do is trade these signals, I'm going to take every signal on faith, go short or get out of my longs when it goes red, get back in. Yeah, you had a couple whipsaws over the years, not a lot. And again, you look at the green and the red, you caught almost all the bull markets and all the out throughout almost all, or I should say the bulk of the bear markets as well. So pretty good stuff, guys. And no need to go to the monthly. I just showed you it started out on SPY, where those monthlies still have a way to go before they trigger. So and from time to time I'll update these, and not a whole lot to talk on the monthlies until we get that those crossovers there. But I'll be watching this one closely. Or actually right now I'll watch those daily trend indicators, because they are still on sell signals, and so that tells me, based on everything else I'm seeing, it is still a short the rips, cover the dips kind of market, instead of a bull market in reverse or bullish trend. Forget about bull bear market, what we're in. There's no way to say this is a bear market now. In hindsight, we could be, because we're off the top. But again, when I'm talking bull bear market, I'm talking more about the trends. And so active trading and even swing trading, because I have all my daily trend indicators on sell signals, that still, like I said, puts me in a short the rips, buy the dips kind of mode. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.